let's start today's live broadcast. The first live broadcast today focuses on a strategy for the Chinese market in 2025, titled accordingly. When resources are running low, doubts emerge, but hope remains. While we do have specific concerns regarding the current macroeconomic situation and the overall market conditions this year, it is crucial that we still maintain a level of confidence in the future market potential. Reflecting on last year's performance in the dynamic Chinese market, we observe that both the Hang Seng Index and the Shanghai Composite Index experienced notable growth, demonstrating a certain increase when compared to various other mainstream markets around the world. This performance highlights the resilience and potential of the Chinese economy amidst global fluctuations. This year, there has been a noticeable increase in overall index performance compared to last year, the year before that, and 2021, resulting in favorable and positive index returns for investors and stakeholders alike. This year's trend demonstrates a series of positive returns, primarily driven by a significant increase that began in August. From last August through late January of this year, we have observed the entire market index center shift noticeably upward, indicating a robust recovery and growth in various sectors during this period. The first wave was mainly due to the introduction of a trillion yuan government bond at the end of 2023, which boosted market sentiment, but subsequent policy effects were not very good and fell short of expectations. Following the recent rise, there has been a noticeable downward trend. In the second phase, spanning from January of this year to May, the central bank's strategic reserve requirement and interest rate reductions, along with enhanced real estate policies, significantly boosted market sentiment, which was further complemented by the notable return of foreign capital inflows into the market. The Hong Kong stock market experienced a swift and ongoing increase. The third phase, from May to September this year, saw a reversal in policy expectations, with profit-taking after continuous gains, and domestic economic data showing some weakness, leading to a pullback in the Hong Kong market. The fourth phase, which is the main period of gains this year, started in September and continues to the present. Policy has intensified, with positive signals emerging from the Central Political Bureau meeting. Hong Kong's market has reached a new high this year. However, after this surge, we see that the subsequent implementation of policies and their sustained impact have not been very strong, leading to a period of volatility. The fifth phase of market activity began at the end of October, following a notable decline in trading enthusiasm related to Trump in the United States. As a result, the Hong Kong market is currently experiencing a relatively narrow range of fluctuations, indicating a period of uncertainty and cautious sentiment among investors as they await further developments. Especially after the new year this year, we have observed that the Hong Kong market has been particularly volatile, which indicates that the overall trend for the Hong Kong market in 2024 is still of considerable structural significance and warrants careful attention from investors and analysts alike. The significant surge observed in September has effectively shifted the volatility center upward, which is now positioned around the noteworthy 20,000-point level in the market. Meanwhile, when examining the gainers, the index has indeed recorded some notable increases this year. However, we must emphasize that it is still heavily influenced by just a few major stocks that dominate the market, which limits the overall breadth of the gains across other stocks. In our analysis, we observe that key sectors such as technology, energy, finance, and telecommunications collectively dominate the weighted stocks within the Hang Seng Index. Notably, companies like Meituan have demonstrated impressive performance throughout this year, contributing significantly to the overall market dynamics and trends. Xiaomi has impressively achieved new highs in the market today. The three major oil companies in the energy sector, along with the three major telecommunications companies and banks and finance, are all major stocks, and their gains have driven the index upward. However, we see that ordinary retail investors are more concentrated in mid-sized enterprises, such as real estate, healthcare, construction, and consumption, which have recorded some declines. Certain sectors have experienced losses. Thus, while the Hang Seng Index has notably recorded gains this year, the internal economic situation remains quite polarized and divided. The A-share market is similar. The analysis shows that the top performer this year is clearly the banking sector. The non-bank sector encompasses insurance and brokerage services. Telecommunications are a certainty. Naturally, there are still certain expectations regarding consumer spending and consumption this year. We should mention that the electronics industry may see significant recovery, particularly from the semiconductor or chip sector, which has indeed experienced waves of speculation this year. Additionally, we see that the relative performance of other industries remains quite average. Looking at the trading volume in both markets this year, after a significant rise in September, the overall trading volume, whether in the A-share market or the Hong Kong market, has shown some recovery compared to last year. This is indeed a noticeable and certain improvement. This phenomenon can be attributed in part to the significant rise of blue-chip stocks, because their prices tend to be relatively high and their trading volume continues to increase. This rising volume inevitably contributes to an overall increase in the trading activity throughout the broader market. At the same time, it can significantly boost overall market confidence levels. The strength of this boost is still uncertain. At this moment, we cannot say for certain, because throughout the year, their significant rise has not resulted in any increase in most small and medium-sized stocks, only their own individual gains. This is our perspective on the internal market. Therefore, we observe that this year's Hong Kong market, along with the A-share market, has experienced both fluctuations and stability. Although we have released signals of political expectations domestically, and there are expectations of an earlier interest rate cut overseas, the Hong Kong stock market has been fluctuating, rebounding, and adjusting. This year, the A-share market and the Hong Kong market have shown a rather erratic trend throughout the year. Having discussed the market, let's talk about our overall macroeconomic situation. To understand the macroeconomic outlook for 2025, we must first examine China's economy in 2024. In the year 2024, the overall macroeconomic environment for China continues to experience considerable pressure and challenges. The severity of both internal and external factors is significant. However, our country is still making efforts in terms of fiscal policy, monetary policy, employment, industry, and regulatory measures. Overall, particularly since September, a series of incremental policies has significantly boosted market confidence among investors. On the fiscal side, we see that the fiscal capacity for 2024 has actually exceeded 4 trillion. The newly established local special bond limit has impressively reached a staggering 3.9 trillion, marking the largest scale ever recorded in history. A total of 1 trillion ultra-long-term special government bonds have been issued. This initiative encompasses two critical aspects: the significant implementation of strategic plans and the development of capabilities in key areas, alongside a comprehensive approach that includes restructuring 12 trillion in local debt. So, on the fiscal side, regarding monetary policy, in 2024, the one-year RPR has decreased from 3.5% to 3.1%, a drop of 35 basis points. The 5-year LPR dropped from 4.2% to 3.6%. The largest historical decrease is a reduction of 60 basis points. The People's Bank of China has reduced the reserve requirement ratio twice this year by 1 percentage point, adding over 2 trillion in liquidity. In terms of domestic demand, we have seen new policies launched to stimulate consumption, with the trade-in program gradually increasing in intensity, and 2 rounds have been introduced. In relation to policy innovation, particularly concerning monetary and financial instruments, we observed following the Politburo meeting in September that several measures, including stock buybacks and pledged reloans, were implemented specifically to bolster corporate buybacks and enhance market stability. Additionally, there are highly convenient interconnections specifically designed for securities, funds, and insurance, which have already begun to operate effectively this year. Moreover, there are innovative structural monetary policy tools that precisely target certain enterprises, which is reflected in the overall macro PMI. PMI expansion suggests an expected acceleration in recovery. Looking at November's China PMI, it is above the control line at 50.3%, up 0.2 percentage points from last month. A series of policies on both existing and incremental loans are being implemented, and we see that the PMI data is showing a certain acceleration, with improvements on both supply and demand sides. The production index and the number of new orders have both demonstrated a notable rebound compared to the previous month. Among them, new orders have now entered the expansion zone for the very first time since May of this year, which indicates a noticeable increase in manufacturing market activity and a significant improvement in the overall sentiment of small and medium-sized enterprises. This positive trend suggests a revitalization in the sector's outlook. Additionally, we see that market expectations remain relatively positive, with the Production and Business Activity Expectation Index at 54.7%, also up 0.7 percentage points from last month. Since November, China's non-manufacturing index has also risen above 50%. Service sector sentiment has improved from last month. Certainly, here's an expanded version of the original text. As we all know, this situation does not overlook the reality that as the end of the year draws near, service and commercial activities have notably increased and accelerated. In contrast, the construction sector's overall sentiment has experienced a decline, which is likely connected to the traditional off-season in the real estate market, particularly with the arrival of winter and its associated weather challenges. The cold in the north will affect outdoor construction to some extent. PMI's current situation. In October, the CPI rose by 0.2% but fell by 0.6% month-on-month, while the PPI experienced a slight decrease with a 0.1% month-on-month increase. However, we still observe a certain degree of divergence between CPI and PPI. Food prices are indeed a significant factor in the CPI. The key components of the Consumer Price Index, CPI, include pork products, along with a variety of fresh vegetables and seasonal fruits. If there is a certain decrease, it will indeed have a significant impact on CPI. Of course, in our country, the Producer Price Index, PPI, significantly drives the overall operation of the Consumer Price Index, CPI. If PPI shows a relative downward trend, it will still have a notable impact on CPI. Therefore, before looking at the CPI and PPI indices, we should observe GPI. If it rebounds, it will directly support CPI. The Political Bureau meeting also mentioned next year's expansion of domestic demand. The expected growth in household consumption will accelerate significantly, which will also help boost the Consumer Price Index, CPI, to some extent. This development serves as another important influencing factor in the economy. Consumption in the three pillars: exports, consumption, and fixed asset investment. Currently, national statistics show that the total retail consumption in the domestic market for the year is 4,376.3 billion, with a year-on-year growth of 3%. Consumer goods, excluding autos, total over 3,890 billion, marking a 2% annual growth. After a series of significant price reductions, the overall stimulus for consumer spending has somewhat diminished and is not as strong as before. The entire automotive industry is currently experiencing a highly competitive landscape, and the recent price cuts for new energy vehicles are particularly substantial, which could potentially impact the retail market share and overall data trends within the automotive sector as a whole. There has been a certain improvement on the supply and demand side. The production index and the new orders index have both shown a significant rebound compared to the previous month. Currently, upon examining the trends in consumption, coupled with the growth in total retail sales, along with the anticipated stimulus for consumption next year, we believe this combination may lead to a relatively stable and sustainable growth process in the economy over the coming months. Of course, we also need to consider the impact of exports and fixed asset investment next year, which we will discuss later. Regarding exports, we saw a year-on-year growth of 5.8% in total exports for October this year, with a month-on-month increase of 1.5%. Imports fell by 4.7% overall, but rose 1.2% from last month. Currently, the trade surplus continues to exhibit a positive growth trend, reaching over $690 billion. This does not completely rule out the possibility that, next year, exports could be significantly affected, particularly as we approach the end of the year. Many economists and brokers are expressing growing concerns about the stability and performance of the overseas market. This is particularly concerning when considering the significant impact of tariffs imposed by the Trump administration. In our upcoming second and third live broadcasts, we will specifically focus on the significant impact of tariffs on our country's economy. I won't elaborate further here, but we assert that among the three key economic drivers, exports next year will still require significant attention and action from the government to address effectively. As for fixed asset investment, from January to October, national fixed asset investment has seen a year-on-year increase. We observe that among the primary, secondary, and tertiary industries, only the tertiary industry has recorded a noticeable decline, whereas both the primary and secondary industries have demonstrated some signs of recovery and improvement in their performance. Notably, fixed asset investment, excluding real estate development projects, still shows some signs of gradual recovery. In fact, if we exclude the real estate sector, the completed amount of fixed asset investment remains quite substantial and noteworthy, highlighting strong economic activity in other areas. From January to October of this year, private investment has experienced a notable year-on-year decline, but when we exclude the real estate sector, it still demonstrates an impressive 6% increase overall. So, whether it concerns fixed asset investment or private investment, the current negative growth primarily arises from the significant impact of challenges in the real estate market. The current data on real estate investment isn't particularly encouraging or friendly at the moment. I can only reiterate that the outlook is not very positive. For the country, as we look ahead to the upcoming year, there are indeed numerous measures and strategies that are urgently needed to effectively address the challenges within the real estate sector. Considering the recent adjustment of the loan prime rate, LPR, and its impact on the real estate sector, as we analyze China's macroeconomic outlook for the upcoming year, it is important to note that this period marks the concluding year of the 14th five-year plan, making it a pivotal time for economic strategy. There will continue to be a strong and persistent demand for economic growth. As we previously mentioned, the primary challenge we face is the current external economic and trade environment. Uncertainty is steadily increasing, and overseas growth is facing significant bottlenecks that could hinder progress. China may encounter dual challenges related to both the overall total volume of its exports and the percentage share that those exports represent in the global market. Given the significant impact of the U.S. tariffs imposed on China, we anticipate that exports next year could experience a decline compared to the previous year, potentially affecting trade dynamics. This situation will create a significant drag on China's overall macroeconomy in the upcoming year. However, the drag may not be too significant. Our country's macroeconomic policies are indeed very responsive. If there is a significant and noticeable decline in exports, I firmly believe that the government will respond to this economic challenge with macroeconomic policies that are quite proactive and effective. Secondly, we see the earlier consumption. For the country's economic stability, if we can actively promote resident consumption and encourage fixed asset investment, particularly in the real estate sector, we can effectively mitigate the adverse impact of declining exports on our overall economic growth and resilience. This approach could significantly help stabilize the annual GDP and facilitate a steady economic recovery over time. We also expect that next year's GDP growth in 2025 may be around 5%, between 4.8% and 5%. The economic rhythm is expected to exhibit a distinct pattern, starting with high levels initially and declining later, presenting significant challenges in the near future. Furthermore, we have yet to account for the upcoming Central Economic Work Conference scheduled for the end of this year, as well as the important two sessions occurring in March. These may be important windows for policy enhancements. Therefore, if there is a significant push in this particular area, the initial high target may still be realistically achievable. This is especially true with the upcoming fourth plenary session. If it continues to concentrate on deepening reforms, it could effectively address the ongoing export decline and the various trade disputes we are currently facing. If we actively strengthen both consumption and the real estate sector, it could offer us a comprehensive and insightful view of the economic situation we might face next year. Regarding the LPR, we believe there is still some room for further adjustment to better align with current economic conditions. As we just mentioned, the fiscal policy next year will mainly counteract the decline in export tariffs, and fiscal measures will certainly need to be enhanced. It is essential to enhance the structure of fiscal expenditures and improve fiscal qualifications continuously. This encompasses enhancing the efficiency of overall fiscal fund utilization, along with tackling local debt challenges, which must transition into a meaningful and substantive phase of debt reduction to ensure financial stability and sustainability. In terms of fiscal policy, the intensity and proactivity we will encounter next year will be especially important for economic stability. Monetary policy may lead to a possible decrease in the LPR. The easing cycle has not yet concluded, but we must closely monitor our country's position and approach regarding the exchange rate fluctuations. At present, we possess a diverse array of monetary instruments that are readily available to effectively address various policy needs, and we additionally have access to several innovative and forward-thinking monetary policy tools to enhance our strategies. Considering the current landscape of the loan prime rate, LPR, and prevailing interest rates, we firmly believe that if we encounter external monetary easing, like if the Federal Reserve decides to halt its rate cuts or even maintains its current rates. While our country grapples with significant economic pressures, there may be one or two interest rate cuts on the horizon, potentially in the range of 40 to 50 basis points. In that case, our approach to monetary easing may encounter a dual pressure concerning both the overall total volume and the structural aspects involved. Regarding the loan prime rate, LPR, it currently reflects the actual interest rate prevailing in the market, and since the LPR remains above the actual economic growth rate, there exists some flexibility and room for adjustments moving forward. The decline of the LPR will also have considerable and significant implications for the entire real estate sector in the near future. Of course, we say that the expectation of rising inflation is something to consider for our country next year. But this year, there are voices suggesting that we might enter a phase of deflation. However, we can clearly observe that our country possesses a relatively wide array of effective tools for implementing macroeconomic responses, as well as diverse monetary and fiscal policies designed to stabilize and stimulate the economy during various economic conditions. Therefore, although there is noticeable deflationary pressure in the economy, it might still be premature to conclusively state that we have genuinely entered a period of deflation. Furthermore, the ongoing pressures we are currently encountering concerning inflation expectations arise from overcapacity issues found in specific industries, coupled with a significant mismatch between public demand and the actual demand from enterprises. The decline in household income, employment challenges, and aging demographics all play a significant role. If we can effectively accelerate essential structural reforms on the supply side, such as eliminating inefficient production processes and significantly speeding up the mergers and acquisitions of companies, it may ultimately contribute to an increase in residents' overall income levels and improve their financial well-being. This could also have a positive effect on employment levels and broader macroeconomic expectations for the region. Thus, as we mentioned, our country needs to enhance inflation expectations alongside efforts in industrial, macro, and monetary policies. Furthermore, in relation to overall consumption, it is crucial that we boost domestic demand significantly. If exports experience a noticeable decline and fixed asset investment is negatively impacted by issues in the real estate sector, we must take proactive measures to enhance and stimulate domestic demand effectively. For instance, we should significantly increase direct fiscal investment in final consumption, while actively encouraging businesses to innovate and diversify their services, ultimately aiming to promote sustainable income growth for individuals and communities alike. This means creating more consumption scenarios. We should actively implement thoughtful policies aimed at stimulating consumer spending and cultivating innovative new consumption scenarios and formats to encourage increased spending. Encouraging consumer spending while stimulating income. We have just discussed the topic of real estate, and we predict that in the upcoming year it will enter a critical observation period. This is particularly true if our country prioritizes real estate development next year, which includes managing land reserves effectively and implementing strategies to control the allocation of new real estate land. This focus could significantly influence market dynamics and investment opportunities. If we can successfully stabilize the real estate market to some extent, then in the first half of next year, if the decline in real estate values narrows significantly, it could lead to a positive and beneficial impact on overall real estate investment and fixed assets across the board. This stabilization may encourage investor confidence, which in turn could stimulate further activity and growth in the market. However, we assert that a significant rebound in the real estate market is currently not on the horizon, primarily because we are still in the process of addressing and digesting the existing challenges and issues that persist within the real estate sector. These challenges continue to impact the overall market dynamics and confidence in recovery. So, the various economic pressures we will encounter next year encompass local debt resolution strategies, the ongoing management of real estate inventory levels, inflation expectations among consumers and businesses, and our responses to international monetary and fiscal policies implemented by other countries. Uncertainties are quite prevalent. Regarding the impact of overseas markets on China, I will refrain from going into too much detail on this subject. This is because there will be knowledgeable guests present who will thoroughly discuss and analyze the effects of tariffs on the Chinese market, providing valuable insights and perspectives that are worth paying attention to. So I will just briefly mention it here for clarity and to provide context. Overall, In relation to overseas markets, it is crucial to mention the Federal Reserve's recent interest rate cuts. This year alone, the Fed has implemented 3 significant rate cuts to stimulate the economy. Regarding the potential number of rate cuts that may occur in 2025, it remains quite uncertain at this time, as various economic factors and trends will likely influence the decision-making process of policymakers in the coming years. However, the main issue is the policy towards China. Apart from tariffs, there are also restrictions on technology and industries, which may have a gradual impact. Since Trump took office, the speed at which he formed his cabinet has been notably swift, featuring quick and decisive nominations for key positions. This has led to a much quicker pace in appointing cabinet members compared to his first term. The swift and accelerated formation of the cabinet will lead to the prompt and timely introduction of related policies that are essential for effective governance. For example, strict controls and large-scale deportations in immigration areas like Canada, the Philippines, and Mexico. In terms of international diplomacy, there may be a greater emphasis placed on engaging with China. Especially in trade, there may be more emphasis on tariffs. In the realm of finance, we can articulate that one approach involves implementing tax cuts, while the other focuses on reducing capital, which he must effectively address. We observe that if the Federal Reserve decides to cut interest rates once next year, it seems likely. However, they may also choose to pause any further rate cuts afterward. If this situation occurs, it could potentially create significant uncertainty and unpredictability in our country's overall policy response and decision-making processes. This uncertainty may affect various sectors and lead to unpredictable outcomes that could impact the general populace. Currently, in the ongoing trade disputes, the latest proposals for trade relations with China in 2024 suggest implementing a baseline tariff of at least 10%, while China may potentially face tariffs reaching 60% or even higher. This is a concept that everyone readily comprehends. Therefore, we emphasize once more that the macroeconomic landscape of the Chinese market in 2025 will require our focused and careful attention. Furthermore, the considerable difficulty of finding suitable substitutes for goods in our country presents a significant challenge. Therefore, it is essential to thoroughly assess the impact of existing tariff policies while simultaneously seeking out new and innovative export products to help offset these challenges effectively. As we have just mentioned earlier, consumption and domestic demand must be carefully balanced against various other important aspects of the economy. Overseas, we will just briefly mention this topic, as there will be more detailed discussions later on regarding it. Upon returning to the market, we observe that the current state of the business markets reflects a distinctly pessimistic economic outlook, which has emerged after several years of steady accumulation and growth. This shift in sentiment among investors and analysts highlights growing concerns over future economic stability and potential challenges ahead. While there are widespread expectations for forthcoming incremental policies, the Hong Kong stock market has notably entered a stable trading range. We observe that the recovery of our technology index, finance sector, and energy market has played a crucial role in stabilizing and restoring the overall performance of the entire Hong Kong market, contributing significantly to its resurgence. This stability arises from the market's optimistic expectations regarding future profits, influenced by a variety of macroeconomic, fiscal, and monetary policies implemented throughout the previous year. This development has contributed to a stabilization of capital expectations for the broader Chinese economy, which is expected to positively impact related major assets. Certainly, here's an expanded version of your text. Certainly, if the risk-free rate experiences a decline due to the Federal Reserve's anticipated rate reduction in 2025, it will inevitably lead to a corresponding decrease in the risk-free rate within the Hong Kong stock market as well, affecting investment dynamics and market behavior overall. This notable improvement in liquidity conditions may provide some much-needed support for the Hong Kong stock market. Currently, the price-to-earnings (PE) ratio of the Hang Seng Index stands at 9.26 times, which places it at the 27.2% percentile when evaluated over the past 10 years. The Hang Seng Tech Index is at 21.33 times, which is at the historical 14% percentile. In terms of global valuations, the Hong Kong stock market still has a significant advantage, and currently, the ERP of the Hang Seng Index is 6.8%. Which is around the historical average. So, if the overseas pressure is not too strong next year, and our country responds well or makes positive political efforts, it could provide support and recovery for the Hong Kong market or the A-share market. This strategy could potentially help to a certain extent in effectively supporting and restoring the overall Hong Kong market, promoting stability and growth in the region's economic landscape. We have observed that the valuation and liquidity of the Hong Kong market continue to demonstrate certain valuation advantages consistently over the years. This year, compared to last year, the volatility range has increased. Last year, the Hang Seng Index was around 18,000 to 17,000, and this year it has risen to a range of 20,000 to 21,000. The level of 21,000 represents a favorable balance of earnings expectations, prevailing risk-free rates, and various valuation advantages. We also see that southbound capital has been continuously flowing in, with net purchases in 2024 reaching $744 billion compared to last year. Indeed, southbound capital has become one of the important participants in the Hong Kong market. On average, it accounts for approximately 30% of the entire total market turnover. If the expectations for economic growth and market performance rise next year, we firmly believe that southbound capital will continue to increase significantly or flow in on a larger scale. Additionally, we have observed further improvements in the mutual recognition process, which facilitates cooperation and investment opportunities between markets. Previously, we saw only 30% to 50%, but now it has increased to 80%. Therefore, this serves as a strong indication of the robust liquidity present in the Hong Kong market, as well as the substantial buying power exhibited by southbound capital investors. As for next year, concerning our strategic approach and industry allocation within the Hong Kong market, we anticipate that by the year 2025, the Hong Kong market will encounter numerous uncertainties and challenges that could impact our investment decisions and overall performance. This is because the domestic economy remains somewhat unclear. The new U.S. government's trade protectionism may, to some extent, suppress our overall exports and increase the difficulty of our monetary and fiscal policy responses. At the same time, we see that the U.S. economy remains relatively robust and continues to show strength. Interest rate cuts this year are limited, and there is a possibility that they might even pause altogether. In this regard, U.S. capital, along with global overseas funds, may largely remain within the borders of the United States because U.S. assets provide significant advantages, such as stability and strong returns, making them an attractive option for investors seeking reliable opportunities. This may affect the inflow of new capital into the Hong Kong stock market. Currently, the risks in the Hong Kong stock market are low, indicating some potential for valuation growth. Although the general optimism surrounding expectations is currently somewhat low, we still need to gradually and carefully assess the various uncertainties that may arise for the upcoming year. However, if we witness effective policies being implemented or observe operational effects improving positively, it may ultimately lead to a sustained upward shift in the overall Hong Kong stock market, fostering greater investor confidence and potential economic growth. We have strong confidence in the effectiveness of the current monetary and fiscal policy tools being utilized by the country, which have the potential to effectively mitigate and reduce significant risks that may arise from international factors and challenges abroad. Thus, if the economy manages to stabilize effectively, or if implemented policies successfully promote economic stability, it could significantly enhance corporate profit expectations. As we mentioned earlier, after the rebound in expectations, including the current valuation of the Hong Kong market, with improved expectations and increased industry prosperity, it may also raise the profit margins of Hong Kong stocks. Thus, while our structural market conditions will persist in their current state, the central points may also shift upward over time. So under optimistic expectations, we can say it might recover to around 22,000, or about 22,500. However, if the policy implementation isn't executed smoothly, or if we witness fluctuations similar to those observed this year, a relatively neutral rating would still be positioned around the 20,000 level, indicating a balance between various influencing factors in the economic landscape. So, as we've just mentioned, looking ahead to next year, when it feels like the road is obstructed, we can still identify a glimmer of hope. This hope is intrinsically linked to the political enthusiasm and strength that our country demonstrates in the current year. Will there be clearer, more positive, and stronger implementations of policies that can effectively address current issues, only then can we truly see that faint glimmer of hope shining through. If the market continues to exhibit as much fluctuation as it has this year, we might still find ourselves experiencing a generally structural market environment. When we examine the market trends from this year in comparison to last year's performance, we can clearly identify our current macroeconomic expectations. These include key factors such as consumer spending, advancements in artificial intelligence technologies, and the growing sector of new energy vehicles. We will continue to pay close attention to specific sectors, particularly focusing on certain technology sectors. Those are roughly the main points I wanted to cover in my speech today. Are there any questions or clarifications needed? If there are no further questions or comments from anyone in the audience, we will now conclude today's very first report. We will then hand it over to our next esteemed guest, who will provide additional related live reports. Thank you very much for your attention, everyone.